They didn't just act, they waited. They waited for the moment when trading volumes would evaporate, when liquidity would thin to the point of near invisibility, and when the eyes of the market were all looking elsewhere. And then, in the final hours of the year's last trading day, they moved. If you glance at your screen right now, what you're seeing is nothing short of chaos. Silver has plunged to 70.50 cents. Just yesterday, it was at $75. That's a $6.50 drop in a single session, a sharp, gut-wrenching move that leaves portfolios painted red. If your stomach is churning, rest assured you are far from alone. Thousands of investors are watching paper gains from the past 2 days vanish as if they were never there. But here's the kicker: this plunge isn't about silver's intrinsic value. Not even close. The underlying strength of the market hasn't changed, and the fundamentals that have kept silver scarce and valuable remain intact. What you're witnessing is a highly mechanical, predictable, and temporary phenomenon, one that repeats year after year without fail. It's a story of bureaucratic timing, thin liquidity, and regulatory pressure, not of silver suddenly losing its luster. Let's break it down. December 31st isn't just another day on the calendar for major banks. It's the day when regulators take a snapshot of every balance sheet, freezing every asset, every position, every ounce of risk exposure. That single snapshot dictates capital requirements for the following year, sometimes forcing institutions to park billions of dollars in low-yield, low-risk assets instead of putting that capital to work. For banks managing billions, this isn't trivia, it's a game changer. The framework governing this is called Basel III. Within it, there's a critical metric called the G-SIB score, Global Systemically Important Bank Score. Essentially, the higher this score, the more capital banks must set aside. And guess what increases that score? Volatility, risk, large holdings of precious metals like silver. From a regulator's standpoint, owning significant amounts of silver is akin to walking a tightrope in a windstorm. So, what does a savvy risk officer do when the clock is ticking toward midnight? You guessed it, they sell. They liquidate large positions in silver, offload gold, trim bonds, anything that could inflate the risk metrics. They convert everything into cash, dollars that sit quietly on the balance sheet. And that is exactly why the charts are screaming red. Gold is down $76 today, trading around $4,294, while silver, being smaller and more volatile, amplifies every move. It's a simple equation. When gold sneezes, silver catches pneumonia. But, and this is crucial, this selling frenzy has a built-in expiration. At midnight, when the snapshot is taken, the regulatory pressure evaporates. The forced liquidation ends, and capital flows back into markets. History is remarkably consistent here. December 31st sees banks selling to clean up balance sheets, and January 2nd often brings a sharp, V-shaped recovery. What you're seeing today is just the sell side. The buy side is queued up to flood back as soon as the new year opens. Layer onto this the factor of volume. Today, the market is thin. Many traders have already checked out, gone home, traveling, or simply done with the year. Institutional desks are operating with skeleton crews, tray-moving large positions in that environment, and prices swing violently. Selling 5,000 contracts might knock 50 cents off the price. 10,000 contracts, $2 down. Speed matters more than efficiency. Hitting the regulatory deadline matters more than the best price. This is why each wave of selling feeds the next. Meanwhile, the dollar becomes the other side of the story. As banks convert assets into cash, the demand for dollar spikes. Every major institution globally is reaching for the same thing at the same time: liquidity. The result? A temporary dollar shortage and a surge in the dollar index. This isn't because the US economy suddenly got stronger or because new economic data came in. It's purely regulatory mechanics in action. The knock-on effect is clear. Commodities priced in dollars get crushed. Oil, copper, agricultural products, and yes, silver all slide lower because the stronger dollar makes them more expensive for international buyers. But remember, this dollar rally is artificial. It's a manufactured squeeze driven by timing, not fundamentals. And the Federal Reserve knows it. Every year, they monitor these year-end patterns, ready to inject liquidity via repo operations or overnight lending facilities, instantly neutralizing the artificial shortage and letting prices normalize. Now, let's talk technicals. Sure, the charts are scary. Silver has dipped below $72, printing a large bearish candlestick on the daily time frame. On paper, it might look like a breakdown. Momentum traders and algorithms could interpret this as a downtrend, triggering secondary selling. But if we zoom out, the bigger picture tells a very different story. 70.50 cents has emerged as a magnet. Every time the price approaches this level, buying volume spikes. Someone is stepping in, scooping up silver at these temporarily depressed prices. Who are these buyers? Likely a mix of industrial users needing silver for manufacturing, long-term investors betting on scarcity, and contrarian traders who thrive on panic. They are strong hands, not forced sellers acting strategically while others react emotionally. This is a critical point. The market is testing your conviction. Price and value are not the same. The market is offering a quote, but nothing fundamental has changed. Supply deficits persist. Industrial demand hasn't evaporated, and the long-term reasons to own silver remain intact. This is also why the physical market tells a different story. A spot silver may be $70.50, but dealers are charging higher premiums, $12 to $15 over spot in some cases. Why? Because this crash is largely in paper markets, not the real physical world. Dealers can't risk selling inventory at artificially low prices, knowing the real cost to replace it remains higher. The physical market, where actual metal changes hands, is showing resilience, not panic. Industrial buying further cements a market floor. A procurement officer at Tesla, Samsung, or Panasonic suddenly finds silver at 70-50 cents instead of $75. This isn't a loss. It's an opportunity to lower production costs. Orders go in, and the metal leaves the investment market, permanently transformed into solar panels, electrical components, and medical devices. It's consumed, creating a natural floor that stabilizes prices and absorbs panic selling. Emotionally, this is a challenging time. Seeing portfolio values plunge triggers the brain's loss response, making it feel like everything is crumbling. But if you didn't sell at $75 yesterday or $70 today, nothing is actually lost. You still own the ounces. The market is simply offering a different price. Understanding the difference between price and value is the cornerstone of strategic investing. Ultimately, this violent shakeout is precisely what we expect in bull markets. The strongest rallies are always preceded by the harshest tests, transferring assets from weak hands to strong hands. The banks selling today aren't abandoning silver, they're complying with regulation. Once the snapshot is taken, they return as buyers. Those who held through the storm didn't panic, positioning themselves perfectly for the rebound. So, while charts look dramatic and portfolios feel battered, recognize the pattern. This is not a crash. It's a temporary squeeze driven by year-end mechanics, regulatory timing, and thin liquidity. The smart money is quietly preparing to re-enter, and industrial demand ensures a floor beneath the market. When the buying wave hits, the rebound could be swift, sharp, and profitable for those who remained patient. And that's the story behind today's turmoil. Not a collapse, not a loss of faith in silver, but a temporary, mechanical shakeout designed to satisfy bureaucratic rules, magnified by low volume and cushioned by strong buyers and physical demand. This is the kind of market event that separates casual investors from those who understand the machinery behind price movements and value creation. Markets have a way of teaching lessons, often at the worst possible moment. Today is no exception. While banks are unloading paper contracts to satisfy accounting rules, industry buyers are quietly taking actual physical silver off the table permanently. This accelerates the underlying shortage. Metal moves from weak hands to strong hands, from paper to physical, from temporary holders to permanent consumers. Every ounce leaving the market strengthens the structural bull case, even as prices appear to collapse on the screen. And there's another dynamic that's quietly fueling today's chaos, the short squeeze reload. Earlier in the week, some banks and hedge funds covered their short positions when prices rallied. They took their losses, exited, and thought they were safe. But now, to push prices down again, they've likely re-entered those shorts, selling fresh contracts to maintain downward pressure. Essentially, they've stepped right back into the trap they just escaped. They covered on Tuesday, re-shorted on Wednesday, and when prices rise again, they'll be forced to cover at higher levels. The can they kick down the road is now rolling uphill, and eventually it will roll right back onto them. The short interest in silver has been reloading all year, and every cycle leaves these players more exposed. That's the squeeze everyone is waiting for. And today's action just loaded more fuel into that eventual fire. Now let's talk about the January effect, because it explains why the next few days could be explosive. January 2nd isn't just another trading day, it's the day when fresh capital floods markets. Pension funds allocate. Endowments deploy, 401k contributions hit accounts, and managed money that's been idle returns to active positions. Billions upon billions of dollars re-enter the system in the first trading week. Right now, markets are illiquid. Selling pressure is magnified. But in 48 hours, buyers return, volume surges, and capital comes back. When that wall of money hits a market artificially suppressed, the reversal can be violent. Silver could jump from $70 to $75 in a single session, a 7% move in one day. In commodity terms, that's entirely plausible. Think of it like a slingshot. The further you pull back, the more energy is stored. Regulatory selling and year-end mechanics are pulling the price down today, but that tension is building for an explosive upward release. Some of you might be wondering, could this be the top? Could silver collapse all the way back to $50 or below? Let's reason through it. For silver to fall that far, We'd need either a global economic collapse or an immediate resolution of the structural supply deficit. Neither is realistic. If we faced deflationary collapse, governments would respond by printing money, injecting liquidity, and propping up the system. That intervention would push commodities higher, not lower. Fundamentally, silver's structural deficit, industrial demand, and constrained supply prevent a meaningful real-term decline. Price action today is temporary. The math supporting scarcity and value hasn't changed. Emotionally, how should you handle the next 24 hours? Step 1. Stop obsessively checking your portfolio. Seriously, close the apps. Turn off notifications. Watching your account tick down does nothing productive. It only depletes your emotional capital. Step 2. Use this pause strategically. Audit your storage. Ensure your physical silver is secure. Review insurance coverage and check that your allocation aligns with your financial plan. This enforced break is a gift that allows you to think strategically rather than react emotionally. Step 3. If you have capital ready, prepare your buy order. Should silver dip below $70, that could be the buying opportunity of the quarter. Fund your account, set your limits, and be ready to act. The best prices appear when fear is at its peak, and right now, fear is extreme. Let's move into the technical landscape. A massive bearish candle today disrupts short-term momentum. Traders who bought the breakout above $70 have been stopped out. Trend followers receive sell signals. This triggers cascading technical selling. We've broken support at $72, clinging to $70. Why 70 matters is simple. It's a battleground. It was resistance for weeks. Now, it must act as support. Should the market close below $70, the next structural support lies around $68 in normal Fibonacci retracement of about 38% from the recent rally. Such corrections are healthy, shake out at excess leverage, and create the base for the next upward leg. For anyone who bought in the 70 seconds, it's painful, but it's strategic, not structural. The intrinsic value of silver hasn't changed. Only the liquidity premium has. There's yet another invisible factor adding downward pressure, tax loss harvesting. December 31st marks the IRS deadline for booking losses. Hedge funds or institutions holding losing positions in mining stocks can sell to offset gains elsewhere, tech, AI, or other profitable bets. This isn't negative sentiment towards silver, it's simply calendar-driven selling. Come January 2nd, the tax year resets, and these funds often buy back their positions. The late December depression sets the stage for an early January explosion, the wash sale dynamic in action. Mining stocks illustrate this perfectly. ETFs like GDX or SIJ may appear catastrophic, down 10 to 12%, but that fear is misleading. Cash flow remains robust. Many miners have all-in sustaining costs between $20 to $30 per ounce. At $70 silver, that's $40 to $50 per ounce of profit. They are cash-generating machines. Today, the market isn't. Valuing fundamentals. It's pricing sentiment and liquidity. Miners, being high beta assets, exaggerate silver's volatility. That volatility creates opportunity. Generational wealth is built when high-quality producers trade as if silver were $30. Blood in the streets, opportunity on the horizon. Macro factors reinforce the setup. The bond market is selling off, with 10-year Treasury yields spiking. Banks sell bonds to meet year-end snapshots, pushing yields higher. This tightens financial conditions, pressuring risk assets broadly. But higher yields aren't sustainable. The U.S. government faces $36 trillion in debt. Each 1% rise costs hundreds of billions annually. The Fed cannot allow sustained higher rates. They will intervene, buying bonds, injecting liquidity, and suppressing rates. That stimulus flows into real assets, gold, silver, commodities, real estate. Today's apparent bearishness seeds the bullish setup for 2026. When trading resumes January 2nd, the market will see silver at $70, gold around $4,300, and nothing fundamentally altered. Debt remains, deficits grow, geopolitical tensions persist, and the physical shortage remains. Buyers will return pension funds, industrial hedgers, and strategic funds. G-SIB-driven selling and tax loss-induced pressure vanish. This creates a vacuum. Forced sellers are gone, buyers dominate, and prices rise to find equilibrium. Expect a possible gap higher at the open. The market inflicts pain to separate committed players from opportunists. Longs were punished today, shorts could face the same tomorrow. Physical delivery reinforces the scarcity thesis. January is a delivery month, and open interest remains elevated. Buyers demanding actual metal aren't abandoning contracts, even at lower prices. These are industrial users, securing the physical silver they need for manufacturing. Futures market chaos doesn't impact them. They want atoms, not paper. COMEX vaults continue to drain, spot prices fluctuate, but physical supply remains tight. Finally, consider emotional capital. Financial capital is obvious. It's your cash and investments. Emotional capital is your ability to endure stress and make rational decisions. today consumes emotional capital rapidly. Watching your net worth fluctuate is taxing. Recognize that this is temporary. Markets are testing conviction, not value. If you held through today, maintained discipline, and avoided panic, you are positioned perfectly for the coming rebound. Watching the market unravel like this is exhausting. It triggers anxiety, makes you question your decisions, and test your patience. That's normal human psychology. Our brains aren't wired to enjoy watching red numbers climb. But the best way to preserve your edge, your emotional capital, is to step away. Turn off the screens. Stop calculating your losses from the peak. Those losses aren't real unless you sell. Go spend time with family. Celebrate the new year. Enjoy life. The market isn't going anywhere. It will be right here when you return. Remember why you bought silver in the first place. Was it for a quick trade, hoping to catch a minor swing? Or was it because you understand the long-term structural picture of the unsustainable nature of fiat currency, the inevitable strain on paper markets, the structural deficit in silver itself? If your thesis was the latter, nothing that happened today changes it. The timeline might be bumpier than expected, the path more turbulent, but the destination remains intact. One day of liquidity-driven chaos cannot shake a generational position. Let's widen the lens for a moment and think globally. While New York dumps paper silver, what's happening in Shanghai, Hong Kong, or India? Real-time data is limited, but historical patterns tell a story. Every time the West sells precious metals, the East accumulates. Western paper markets unload, while Eastern physical markets quietly absorb. Today's price collapse effectively subsidizes strategic accumulation by nations who play the long game better than the average Western trader. Generations from now, historians may marvel at how regulatory deadlines and accounting rules allowed Western vaults to feed Eastern ones almost for free. Now let's map out what recovery looks like. First, holding $70 on today's close is critical. Closing above that level, despite all the selling pressure, would be a psychological win for the market. Second, watch the opening Friday morning. A gap higher opening at $71 or $72 would signal that fresh capital is entering and buyers are stepping back in at suppressed levels. Third, reclaiming $73 within the first week of January would confirm that the recent selling was an anomaly, not a trend reversal. If all three conditions happen, we could see a textbook V-shaped recovery back to $75 by next week, potentially reaching $80 by mid-January. Fast down. Fast up, the volatility is driven by liquidity, not fundamentals, and the rebound will match the speed of the decline. Looking ahead to the first week of January, macroeconomic data will play a supporting role. Manufacturing PMI, employment reports, and consumer confidence numbers will all influence the trajectory. Weak data could encourage expectations of a Federal Reserve pivot, lower interest rates, and more monetary accommodation bullish for commodities. Strong data could trigger inflation fears, supply constraints, and higher commodity prices, also bullish for silver. This is the rare win-win setup. Whether the economy booms or slows, silver benefits. The only scenario that truly hurts silver is stability, and in today's global environment, stability feels like a fantasy. Central banks are easing policy, China is cutting rates, Europe is loosening policy, and global liquidity is expanding. This flood of money flows into real assets, and silver is an inevitable recipient. The reality is simple. $70 is just a number on a screen, a temporary reflection of current liquidity conditions. The ounce you hold in your vault, safe, or allocated account represents real, intrinsic value. Its utility is physical, its scarcity is structural, and its history as money is timeless. Today's price drop doesn't change that. Banks used their last tools of the year, leveraged thin liquidity, and exploited regulatory deadlines to instill maximum fear. And you held. You didn't panic, you didn't sell at the bottom. That makes you part of the strong hand, one of the few who understand the critical difference between price and value. The fundamentals behind silver are reaching a tipping point. After 5 straight years of supply deficits, shortages are no longer theoretical, they're visible. Premiums are expanding. Physical demand is disconnecting from paper pricing. Something has to give, and when it does, the price adjustment won't be incremental, it will be exponential. 2026 is shaping up to be a potentially explosive year for precious metals, and your position is perfectly aligned for it. From a technical perspective, we can monitor the market's recovery roadmap. Maintaining the $70 level is the first sign of stability. A gap up at the Friday open indicates buyers are returning. Reclaiming $73 confirms the anomaly is over. These markers, combined with the fundamental backdrop, set the stage for a rapid rebound. Liquidity-driven events like this resolve quickly. Fast down, fast up. The market's volatility is a feature, not a bug. In scenarios like this, the physical market reinforces this narrative. January is a delivery month, and open interest in futures remains elevated. Buyers seeking actual metal, not just paper exposure, are holding their positions. These are industrial users and strategic holders who need the physical metal to manufacture goods. Their commitment validates the underlying shortage thesis. The COMEX vaults continue to drain regardless of spot price, proving that physical demand is real and ongoing. Emotional capital matters just as much as financial capital. Watching net worth fluctuate is draining, but those who maintain discipline, patience, and perspective are positioned to benefit. The market punishes the impatient and rewards the prepared. If you held through today, you're in a stronger position than most. As 2026 begins, the math of structural deficits, premiums, and physical scarcity is reaching its logical conclusion. The disconnect between paper and physical markets is widening. The correction is imminent, and when it arrives, it will be rapid and substantial. You're not reacting to a whim of the market. You're strategically positioned for a major adjustment, one that could reshape the landscape of precious metals investing for the foreseeable future. Finally, maintain perspective. This content is educational. It is not personalized financial advice or a recommendation to buy or sell silver. Precious metals investing carries risk, including potential loss of principal. Past performance is not indicative of future results. Market conditions can shift rapidly, and anyone considering investment should conduct their own research and consult qualified financial professionals. Always invest only what you can afford to lose and maintain appropriate diversification. In short, you're holding a strategic asset at a pivotal moment in history. Today's price drop is temporary. Its intrinsic value is enduring. Emotional discipline, strategic positioning, and awareness of global flows put you in the strongest possible position to benefit from the recovery ahead. The new year is not just a calendar change, it's a reset, a moment for opportunity and a chance to capitalize on structural dynamics that few understand.